Nebius is down about 35% in just 1 month, sliding from roughly $130 all the way into the mid-80s after earnings. And the big question now is simple. Is this actually one of the best high-risk, high-reward setups in the entire AI infrastructure space? So, welcome to today's Nebius Deep Dive. So before we get into the numbers, we need to clear up one thing. Nebius is not an AI model company. It's not trying to be OpenAI or Anthropic or Midjourney. Nebius is essentially a specialized AI cloud and GPU infrastructure provider, meaning they build the power, the data centers, the cooling, the racks, and the GPU clusters that the entire AI industry runs on. They make money in 2 ways. First, and by far the biggest piece right now, is infrastructure revenue. About 90% of their business is simply selling raw GPU compute capacity to whoever needs it most, whether that's Microsoft, Meta, massively growing AI native startups like Cursor, or enterprise customers through their cloud platform. Then there's the software layer, the part Nebius hopes becomes a bigger margin driver over time. That includes their Ether Enterprise cloud platform and their new inference product called Token Factory. These sit on top of the GPU clusters and let companies run high-performance AI workloads with more control and automation. But let's be clear, if you buy Nebius stock today, you're essentially buying a leveraged bet on the global AI data center build-out, because everything in this company comes back to one thing: how fast they can build, power, and fill GPU capacity. Everything. So let's get straight into the earnings, because this is where the story gets interesting. Nebius reported one of the fastest growth rates in the entire AI infrastructure sector. Revenue came in at $146 million, which is up roughly 355% year over year and about 39% quarter on quarter. And most of that, about 90%, came from the core infrastructure segment, which grew close to 400%. But the more important number is this. Nebius ended the quarter with $551 million in annualized run rate revenue. That matters because management keeps repeating the same line. We sell out everything the moment it goes live. They are not demand constrained, they are capacity constrained. Profitability is still early, but not a disaster. The core infrastructure business reached 19%. Adjusted EBITDA margin, which is pretty remarkable for a company scaling this aggressively. The group as a whole is still losing money, but losses are narrowing fast. But the bigger picture remains unchanged. Management is still targeting 900 million to 1.1 billion ARR by the end of 2025, and 7 to 9 billion ARR by the end of 2025. So Q3 was basically explosive growth, improving margins, insane demand, and the same giant bottleneck the company keeps repeating: capacity, capacity, capacity. Now let's talk about the real headline from this quarter: the mega deals. These contracts are why Nebius even shows up on investors' radar, and they're also why this stock is so polarizing. So here's the clean version. Nebius has 2 anchor partners right now: Microsoft and Meta. And together, these deals essentially validate Nebius as a core AI compute supplier, not a speculative wannabe. Microsoft is the big one, a contract worth an estimated $17 to $19 billion spread over multiple years. Only the very first tranche has been delivered so far, which means almost all of the meaningful revenue impact starts in 2026 and really ramps into 2027 when they hit full annual run rate. That's important. The market still hasn't actually seen this revenue yet. It's forward visibility, not current earnings. Meta is the second one, roughly a $3 billion multi-year agreement. And here the deployments are happening much faster. Nebius expects Meta to be at or near full run rate in 2026, with GPUs being energized over the next few months. And here's the nuance the market missed. Meta didn't buy more because they didn't want more. The CEO literally said the contract size was limited only by Nebius's available capacity. If Nebius had more power and more racks lev, Meta would have taken a bigger deal immediately. Together, these contracts give Nebius something most early-stage infra companies never get: long duration, credit-worthy revenue visibility. But they also set expectations really high. And because nearly all of the revenue arrives in future years, the market still treats this like show-me territory. This is the moment that transitions us into the capacity build-out, because that's the whole reason this story either works or collapses. Now, let's talk about the real engine behind the Nebius investment case: capacity. Nebius now expects to reach 2.5 gigawatts of contracted power by the end of 2026, up from just 1 gigawatt previously. That is a huge jump in ambition, and honestly, it's one of the biggest reasons the stock is volatile. If they hit it, the growth story holds. If they miss it, everything breaks. Even more importantly, they plan to have 800 megawatts to 1 gigawatt of connected power, meaning fully built, energized data center capacity, online by the end of next year. That's the part that actually generates revenue. And the way they get there is through a 3-stage capex model they laid out on the call. Stage 1 is securing land and power, which is only about 1% of total capex. Stage 2 is building the shell and cooling, the connected power, which is around 20%. And Stage 3 is the GPUs themselves, which is the real cost, nearly 80%. And they only deploy those once demand or contracts are clearly visible. This model is why they're confident enough to guide for $7 to $9 billion of annualized run rate revenue by the end of 2020. They say more than half of that ARR is already either contracted or very visible. And on paper, yes, the math works. More capacity, plus the Microsoft and Meta deals fully ramping in 2026 can support those numbers. But this is also where execution risk is massive, because to hit that ARR, Nebius has to build hundreds of megawatts across the UK, Finland, Israel, New Jersey, and new US and EU sites, with no major delays, no permitting issues, and no supply chain hiccups. So the ARR story makes sense, but it depends on flawless execution in a very difficult power-constrained environment. Also, Nebius just raised its capex guidance for 2025 from $2 billion to around $5 billion. That's more than 10 times this quarter's revenue. And this isn't a one-off spend. The entire business model requires continuous multi-billion-dollar investment to unlock more capacity, more power, and more GPUs. On the call, management laid out the 3 financing levers they're relying on: traditional corporate debt, asset-backed financing secured by credit-worthy customers like Microsoft and Meta, and the big one, an at-the-market equity program for 25 million new Class A shares. Meaning dilution is absolutely on the table. Now, they do stress discipline. They claim GPUs, which account for roughly 80% of total capex, will only be purchased when demand is already visible or contractually locked in. That's smart, but the reality is simple. Nebius needs a lot of capital, fast, and the pace of build-out is way ahead of its operating cash flow. If credit markets tighten, if customer deployments slow, or if hyperscalers negotiate harder on pricing, Nebius may have to issue more shares. This is the part of the story the bullish articles gloss over. The mega deals help, but they don't magically turn Nebius into a self-funding machine. This is still a capital-hungry business, and investors need to be prepared for the possibility, not the certainty, but the real possibility, that share count grows meaningfully over the next few years. But that is not to say that this investment is not without its risks. Let's list a few. First up, valuation. Nebius is still trading at premium AI multiples. Forward EV are sales in the mid-40s at its peak. Even today, after the drop, it's rich for a hardware-heavy infrastructure business. If AI compute pricing softens, or if demand slows after 2026, that multiple can compress violently. The market is basically saying, show me the execution before I pay up. Risk number 2, the capex monster. Risk number 3, concentration. These mega deals with Microsoft and Meta are great, but they cut both ways. If either hyperscaler slows deployment, delays workloads, or pushes capacity in-house, Nebius feels it immediately. These are 5 to 10-year relationships, but they're still vulnerable to shifts in strategy. And that is without even considering the risk of the whole AI cycle itself. All right, let's talk valuation. At today's price, in the mid-80s, Nebius is sitting at around a $22 billion market cap. And when you compare that to roughly $146 million in quarterly revenue and 500 to 550 million full-year guidance, it is unambiguously a premium stock. No debate, you are paying upfront for the idea that Nebius becomes a core piece of global AI compute. So let's break this down the way real institutional analysts do it, by walking through the big scenarios. And then I'll give you 3 concrete valuation targets. Let's start with the bull case, which is basically Nebius's own roadmap. Management says they can reach $7 to $9 billion of annualized run rate revenue by the end of 2026. And remember, they're already saying that more than half of that ARR is booked or highly visible through signed contracts. If Nebius actually gets anywhere near 8 or 9 billion in ARR, and if margins expand the way they expect as capacity comes online, and software layers like Ether and Token Factory scale, then the stock doesn't need crazy multiples to work. Even an 8 to 10 times sales multiple, which is high, but not insane for a category-leading AI infra provider, puts Nebius somewhere between $70 and $90 billion in valuation. Spread that over the share count, and that gets you a price target between $260 and $330 per share. That's the upside scenario, where this current sell-off looks like the one moment the market completely mispriced a future AI infrastructure winner. Now let's get more realistic. The base case assumes execution isn't flawless. Maybe pricing softens in 2026. Maybe some hyperscaler deployments slip. Maybe AI compute capacity finally stops being scarce. So instead of 8 or 9 billion ARR, let's assume they land closer to 6 to 7 billion by late 2026. That's still huge, but not their moonshot target. In that world, the market probably gives Nebius something like a 5 to 7 times sales multiple. That would value the business somewhere in the 30 to 45 billion range, implying a share price between $115 and $170. From today's mid-80s, that's solid upside. Just not the explosive multi-bagger outcome of the bull case. It's growth, but with some gravity. And then there's the bear case, which is exactly what the market is starting to price in after that 35% slide. This is the scenario where the story doesn't collapse, but it stumbles. Maybe capital costs stay high, so raising more debt gets expensive. Maybe dilution ramps faster than expected because of the new ATM program. Maybe the hyperscaler deals don't scale as quickly. Maybe GPU supply finally catches up and prices fall. In that version of the story, ARR lands well below the company's target, say 4 billion or less, and the market re-rates Nebius as more of a traditional data center operator at just 2 to 3 times sales. If that happens, the stock could be worth somewhere between $8 and $12 billion, which would put the share price in the $40 to $60 range. But to give you something harder, let's run a conservative DCF, using numbers the company can realistically hit if everything goes well, but adjusting for heavy capex and the real dilution risk. They talked about on the call. Let's assume Nebius reaches 6 billion in ARR by 2026. Let's assume long-term margins settle at around 25%, which is conservative for an infra plus software hybrid. And then let's assume free cash flow is deeply negative in 2025 and 2026 because of that enormous $5 billion capex cycle, and only turns positive beyond 2027. with a 12% discount rate, which is high, but appropriate for a speculative infra company. The DCF gives you a valuation of roughly $28 to $32 billion that converts to a share price of around $100 to $115. And that's with conservative assumptions, high discounts, and no heroic growth projections. Then there's a more specific capacity-based model, which institutional analysts love for this sector. If Nebius truly reaches 800 megawatts to 1 gigawatt of connected power by 2026, and if each megawatt of high-density AI compute typically yields $7 to $10 million of ARR, which is right in line with industry norms, then Nebius at 1 gigawatt should produce around 7 to 10 billion ARR. Apply a 5 to 7 times sales multiple, and once again, you end up in the 35 to 60 billion valuation range, or roughly $140 to $230 a share. So what does all of this actually mean? At this price, Nebius is still a high-risk, high-reward play. The growth is unbelievable, the hyperscaler deals are real, and the demand picture looks strong, but the capex, dilution risk, and execution load are just as huge. For me, this is the kind of stock that works as a small speculative position, not a core holding, at least until we see how 2026 capacity, ARR, and funding actually play out. So I'm curious, after a 35% drop, do you see Nebius as a bubble stock or an early pick and shovel winner in the AI compute race?